Hey friends, I'm back. I have 3 dividend stocks that I want to share with you today. All 3 are 20% or more off their 52-week highs. I see a lot of value in each of these 3 individual dividend stocks. I'm so excited to be back. I've been sick for a while, now I'm better. Also, I've been tied up at work with some really big projects, but now I am back here on YouTube. I can't wait to share the video today. Get ready everyone for an exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone. So the first stock I want to discuss today is Realty Income, ticker symbol O. This is a real estate investment trust. It is a company that pays a dividend, but this is not a qualified dividend. It is generally treated as ordinary income, but there's oftentimes some return of capital in there as well. But what I love about Realty Income is their motto. They're the monthly dividend company. They pay dividend distributions each and every month out of the year. And I never really cared about this until recently. If you've been following my channel for a while, you know that recently I made a change. Recently, I've been really going in and using my dividends to help pay bills and to help rebuild our emergency fund savings. We have been relying on dividends more than ever before. And a lot of the dividends right now are not being reinvested. I'm using Realty Income dividends. Here's where it gets interesting. Having that cash flow come in monthly is so helpful for budgeting, for predictability, just for day-to-day financial management. Whereas those companies that pay semi-annually or quarterly, I have to take that money and kind of smooth it out over time. And you would think just getting the lump sum payments, smoothing it out is easy, and it's easy enough. But I would say Realty Income paying monthly, that is a game changer for someone like myself right now that relies on these distributions. So I love that about Realty Income. But what I love even more, as you can see on the screen in front of you, is right now they are paying a staggering 5.55% dividend distribution yield. Now, with Realty Income, I look at this dividend distribution yield of 5.55% and I compare it to the risk-free rate on the Treasury Bond. Right now, the 20-year Treasury, which a lot of you know that I like, it's yielding right around 4.5%. So I'm getting roughly 100 basis points higher of a distribution yield through Realty Income than through the risk-free or semi-risk-free rate of the Treasury Bond. Now, what's funny is I look at Realty Income, which is backed by these triple net leases, by this staggering global portfolio, about $40 billion worth of physical real estate. And I compare that to the Treasury Bond, which is backed by the faith of the U.S. government. Both are obviously solid investments, but some of the time I almost think that Realty Income is stronger than the Treasury Bond. Yet I get 100 basis points more and I have built-in dividend growth because I know with the Treasury Bond I'm getting what I'm getting. It's fixed for the life of the investment. Whereas with Realty Income, I'm locking in a starting yield, but it can only grow over time from there. So it's really exciting. As you can see on the screen in front of you right now, you can see that Realty Income, it's down about 20% from its 52-week high. I believe the reason for that is we are in a high interest rate environment, and there's an inverse relationship between companies, REITs like Realty Income, and the interest rate. Interest rates are up, stock price goes down because most of the investors out there are doing what I'm doing. They're looking at something like Realty Income as an alternative to a Treasury Bond. And of course, Realty Income has exposure and will trade in accordance with what's happening in the global debt markets. Now, what's interesting with Realty Income right now is I look at their adjusted funds from operations. This is the earnings equivalent or earnings proxy for a REIT, and it's 396. I divide that into the share price. I get a PE proxy, or a price divided by AFFO for 2023 of about 14. I look at that as a reasonable, if not discount valuation. That's why I highlight it. What I also want to show here is, of course, the dividend distribution yield of 5.55%, but there is a built-in growth rate there. On average, they're increasing the distribution by about 3.04% per year. So you can see on the right-hand side of the screen a summary of what I like. I love the monthly checks. I love the starting yield. I love that there's dividend growth. And I'm going to share this in a minute, but this Bellagio deal, it's a neat trophy property. They're actually, well, let me share that now. They have infused about $900 some odd million into the Bellagio, the iconic Las Vegas property. Realty Income now owns a piece of the Bellagio. Check it out on the screen. You can see some of the deal terms right there. Now, this isn't going to make or break the company. This is just one investment that they're making, but it is a trophy property. I've stayed there before. Put in the comments below if you've ever been to the Bellagio. What a amazing, luxurious kind of special property that is for those of us who enjoy Las Vegas. And one thing I wanted to share with what you see on the screen right now is the asset valuation is overall at about $5.1 billion. So they don't own all of the Bellagio. They own, say, roughly just under 20% of the Bellagio. But what is important to note here on the rent escalators is it's only going to be 2% per year for the next 6 years. Then it's going to be the greater of 2% or the CPI, but it's capped at 3% in years 11 through 20 and 4% at 21 through 30. You can see with the deal terms that are outlined here that it is very much in line with the overall picture of the company. You've got a starting yield somewhere in the mid 5% range, and you've got kind of built-in increases each year, say on average of about 3%. And the Bellagio deal, it very much mirrors what we see at a company-wide level at Realty Income. So, of course, I'm going to talk about some of the things I don't like as much about this. As you can see on the screen in front of you, what I don't like is there's limited upside. It's only 3% per year growth on that cash flow. It's bond-like, and it has tax consequences that are bond-like, although probably a little better than bonds, just in the sense that some return of capital is happening there. Now, what I would also say I don't like is it's just not that exciting. It's exciting for someone like me who needs predictability, who needs monthly dividends, who values a starting yield in 5.5% range, who is in his 40s. But for a younger investor, I could see how this might not be very exciting or compelling over long periods of time. But for me, this is the perfect type of investment, especially when I look at an investment like this and I compare and I contrast it to alternatives like Treasury Bonds. Now, don't get me wrong, I like Treasury Bonds too. They have their time and place. I've done some videos on that. I'll link to them in the pinned comment below. But overall, I would say Realty Income for me, I like it even more than Treasury Bonds. And so put in the comments below, what do you think about Realty Income? And if you're enjoying the video so far, please do go ahead and click that like button. It means the world to me. So next, what I want to do is I want to go into another stock. And so I've been getting questions about this stock on my Instagram, and I love that because when I receive questions on my Instagram, I'll link to that in the pinned comment below from the community. It always helps me kind of look into my own thinking and what I'm doing in my portfolio. But as you can see on the screen in front of you right now, the next stock is RAYTHEON Technologies. Boy, this stock has been hammered. It is so interesting. It is down almost 30% from the 52-week high, and I felt it was fairly valued at the 52-week high. It is now trading at a forward PE of 14.9 this year, 13.37 next year. It has a starting yield of only 3.16%, but keep in mind that's a qualified dividend, and keep in mind they're growing that dividend on average by 7.49% per year. This is a $109 billion company, so being down about almost 30% from the 52-week high, you can see that this company has erased nearly around approximately $30 billion in market cap. And so what the heck is going on with RAYTHEON? As you can see on the screen in front of you right now, they have rebranded to the name of RTX. But what is going on with these guys? Well, what happened at RTX is basically they discovered that some of the jet engines, or I guess a lot of the jet engines, have been manufactured with this powdered metal. they're basically taking in these powdered metal jet engines and servicing them, recalling parts, fixing them up sooner than is anticipated on the maintenance schedules. And this will be happening, to my understanding, at the company's cost. You can see on the screenshot in front of you that RTX has a pre-tax operating profit that's going to be estimated to be between $3 billion and $3.5 billion over the next several years, and that's inclusive of approximately $3 billion pre-tax charge in Q3. So after partners' share of charges. So I guess their partners have some share of these charges as well. But long story short, RTX is taking a $3 billion charge, and that is going to cover the cost of these repairs. And it's going to be hard. They're going to have to staff up. They're going to have more technicians to service these jet engines and fix them up. Thank goodness RTX caught this potential issue and is doing something about it. But my thought here is company has diminished in value by $30 billion. The charge is $3 billion. Of course, companies trade at a premium to their earnings stream and their future earnings stream. I just feel for those investors like myself who are in this for the long haul, that this stock has overreacted. It just seems like it has aggressively overreacted to this news. And one of the reasons perhaps is this powdered metal. They did hint in the press release that it could be in other jet engines that have not yet been recalled, and they need to kind of look into that scenario. But I do believe in the company RTX because it is a diversified aerospace company that has exposure to defense and commercial. This is a company that is core to our nation's defense system. This is a company that is a really high up on my list. In fact, this was my number 5 largest position, right underneath my core 4, before it fell 30% in value. By the way, with RTX and all of the 3 stocks I'm mentioning today, not only do I own them, but I plan on adding more shares to my personal dividend stock portfolio over the coming weeks, the coming months. But as you can see on the screen in front of you, I want to just share some of the pros and cons with RTX, because this is some pretty big news. There's certainly some risk, but what do I like about it? As I mentioned, it's almost core 4. What do I like? It's diversified industrial aerospace company, and I don't have a lot of exposure to industrials, and so this gives me that exposure. I really think that Mr. Market is overreacted. I really think that this $3 billion charge does not necessarily need to equate to a long-term permanent $30 billion loss in market cap, and so hence I believe they're going to gain some of that market cap back. I'm in this for dividends, and so of course I love it when a stock price goes down because I think they're going to keep paying this dividend and increasing it. They're financially strong. They even said in the press release, they confirmed, despite this $3 billion charge, they're going to repurchase $3 billion of RTX shares for the full year 2023. And so they're not derailing their share repurchases. What I don't like, I think it seems like the stock is just reacting to the downside so aggressively. Am I missing something? Please put in the comments below if I'm just looking at this naively and if you see something with RTX that I'm missing. And could this powder metal issue affect other models, other engines? Could it be future impairment charges? Could there be future issues for this company? And I guess what I did not note on there is, could their end customer, lose confidence in this company because of this situation? Or could it inspire more confidence that they're addressing it so quickly and appropriately? And so it could be one or the other. I don't know. If you work in the aerospace industry, please put in the comments below what you think. I don't know how sticky the relationship is between the jet engine manufacturers like RTX or Pratt & Whitney and their end customers, the airliners, aircraft manufacturers. How does that work? Please put in the comments below if you think RTX could lose faith in the industry, or if they'll possibly gain some faith back, even based on how well they are addressing the issue. All right, everyone, I have one more stock to cover. Before I do that, please go ahead and subscribe. It means the world to me. By the way, this will be a fun one to edit. I've been coughing, still kind of getting through this cold, and so I'm gonna have a lot of editing to do as I go through this video, and so some extra love in the comments below. It means the world to me, the subscriptions, all of that. The third stock that I want to mention today is one I haven't mentioned for a long time, and I don't know why it's down so much, other than maybe it got overvalued or ahead of itself. But as you can see on the screen in front of you right now, I want to talk about General Mills. General Mills is a company that produces both human and pet foods, and they are down a staggering amount from their 52-week high. They are down almost as much as RTX. They've lost 27.2% of their value just in the recent months. And so now on a forward basis, they're trading at a price earnings multiple of 14.73 this year, 13.99% next year. The starting dividend yield is 3.57%, which is awesome. Now, some investors may argue that this stock isn't that exciting because they're only growing the dividend by 3.78% per year. Well, it was lower for a while because they were digesting a very massive Blue Buffalo pet food acquisition. But the last dividend increase was a staggering 9.3%, as I highlight. And so what I like about this company is I get a 3.6% starting dividend yield, but going forward, presumably their dividend growth, it's going to be more like RTX than Realty Income. Over the past 5 years, their dividend growth's been more like Realty Income, but that's just because they had kind of delayed and slowed down dividend growth as they were digesting a huge acquisition. But now they're back on track. I think the acquisition worked out really well for them, and the dividend growth should be more in the range of RTX. And so for me as a dividend investor, buying quality at good valuation, buy and hold forever companies, but then buying ones that tend to increase the dividend 7% per year or more, that is my winning formula that has always worked for me over long periods of time, and especially buying when the stocks have corrected. Now, I've been talking a lot about SCHD recently, and I love SCHD. I'm adding to that a lot, but what I plan to do in the coming weeks and months is, in addition to SCHD, maybe I'll do 1 week SCHD, 1 week I'll add one of these stocks, so on and so forth. My core strategy is always individual stocks. So I have received some comments, Ian, are you changing your strategy? Has everything flip-flopped? No, I love individual stocks. That's always the lion's share of my portfolio, but I'm trying to build up SCHD to be a nice complement of, say, 20 to 30% of the portfolio, maybe as much as 40% one day. But for now, it will always be skewed towards individual stocks. And so that's one of the reasons I wanted to do this video as well. But as you can see on the screen in front of you with General Mills, what I like about it is it's down a lot, and I can't figure out why. Please put in the comments below if you know. The last dividend increase was staggering. Everyone needs to eat. Pets need to eat as well. The adjusted diluted EPS growth is estimated to be 4 to 6% per year on average, which is pretty impressive for such a older established company. And what I don't like as much, I guess, is the starting yield's not that high yet, but I guess I would say maybe it'll go down more. And maybe I can get a starting yield in the 3.9 to 4% range. That would be even better. I want to end the video today with just a screenshot that shows a press release from General Mills. And what this shows is they reaffirm their annual guidance. And they show that they're having impressive growth on net sales, adjusted diluted EPS, free cash flow conversion is great as well. And this is from September 6th, which was just recently. So again, I don't know why it's down so much, other than Mr. Market is giving some opportunities right now to us long-term dividend investors, which is so exciting. I hope you enjoyed the video today. Before I leave, in terms of full disclosure, I am long the stocks mentioned today. I own Realty Income, ticker O, RTX, ticker RTX. I own General Mills, GIS, as well. Also, I'm long SCHD, that Charles Schwab Dividend 100 equity ETF. Love that one as well. I own those positions in my personal dividend stock portfolio. I'm long Treasury Bonds as well. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video, it's just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed financial advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. I'm just sharing my journey. Now, before I go, if you like the shirt I'm wearing today, this is one of my exclusive PPC Ian merch from my store over on Spring. I will link to that Teespring in the pinned comment below. The purchases of the merch always go to support this channel and what I do. I thank you all for hanging in there. I know it's been a long time since my last video. I'm so excited to be back here. I'm so thankful for the community. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.